Now we'll discuss it over
It's going live.
Snack.
It's going live. Ready?
Ready.
Ladies and gentlemen, thank you so much for your patience. We were experiencing some technical difficulties. Jeff Hirsch is here in the room. We welcome Jeff Hirsch, Editor-in-Chief of the Stock Traders Almanac. Jeff, thanks so much. Welcome.
Thanks again. No worries. These things happen. I just want to make sure everyone realizes that they need to wish the Dow Jones Industrial Average a happy 125th birthday today. It's also my 55th birthday, so looking forward to getting taken out tonight. I understand there's a couple other people who have his birthday, Miles Davis and Lenny Kravitz, a couple of cool guys. So anyway, interesting date, May 26th. So without further ado, I'm just going to jump in and run through what we're looking at. So sell in May and go away, not what we do, reposition in May. We are the creators of the best and worst months switching strategy. My father, Yale Hirsch, started it back in 1986 when he first published it in the 87 Almanac, after already inventing a couple other things like the January barometer and the Santa Claus rally. So today we're going to run through some of the repositioning that we do, how we prepare ourselves for the worst 6 months, worst 4 months for NASDAQ, and our expectation for a relatively range-bound market, not too much on the upside, if anything, and not too much on the downside. So just a word from the lawyers first. Past performance is not a guarantee of future results. This is for informational purposes only. Not offer to buy or sell any securities. Do your own due diligence, et cetera, so forth. Consult with your advisors. A little stroll down memory lane. So for those who don't know where we came from, as I just said, I'm 55. The Almanac will be 55 as well. The 22 edition is getting ready to get sent off to the press. You can see here the original 1968 edition with a little note. I believe that's my mother's handwriting where they sent it to a friend of theirs. We got it back to complete my collection. Some of the other books that we've put out there. Not going to get into all of this stuff, but Don't Sell Stocks on Monday, my father's book from originally, I think it was 89. He put that out, if memory serves. Great title, always could turn a phrase. The Super Boom Forecast, which is ahead of schedule based upon the sort of iconic pattern Yale discovered back in '76, where the Dow makes 500% moves following war and inflation, like it did after World War I, World War II. Did it again back in from NAM to 1990, et cetera. Some of the places we get to appear from time to time. So that's just a little background of where we're at. Our philosophy, a little take on the Santayana famous quote that those who fail to remember the past are condemned to repeat it. I like to say that those who study market history are bound to profit from it. But I always love to keep my friend Sam Stovall's words, wise words around as well, that we use history as a guide, not as gospel. I think it was Twain who said that history doesn't repeat, it rhymes, or it rhymes, it doesn't repeat. Anyway, you get the idea. People are creatures of habit, and what they do with their money and how they pay their bills and behave and take vacations creates these seasonal patterns. Our process, we've been doing this for over 50 years, analyzing, researching, testing every major trend imaginable in the market. We publish those findings annually in the Stock Traders Almanac. We update them monthly and weekly in our newsletter service at stocktradersalmanac.com. And we use all this to construct portfolios. We are not just seasonals. It's not just sell and May. We look at fundamentals and technical analysis, market internals and sentiment, put-call ratios, investors' intelligence, new highs, new lows, advanced decline lines, all sorts of things there. We also look at the government policy and monetary policy, very important right now, kind of has a floor into the market, all the fiscal stimulus and accommodative Fed. Of course, current trends in the economy, things are looking pretty up compared to last year, and then our roots and cycles, seasonalities, and recurring patterns. So, seasonality was off kilter last year. We had a big crash, shortest bear market on record, right during the end of the best 6 months, and then through the worst months, as you can see on this chart, with 2020. And remember that the scale for 2020 is on the right side, much more amplitude than the average going back to 50 and 88. You can see we rose pretty strongly right through the worst 6 months. And then right around Labor Day, things started to go back to normal, people behaving a little bit more regularly, more normally. We saw that typical end of Q3 September sell-off, and then a little rally in the beginning of October, and then another late October sell-off. We made a nice little support level here, which will show up in another chart technically, with a higher low, excuse me, from October to September. And you can see how this sort of action tracked the seasonal pattern average. We use 88 because that was the first year after the 87 crash, where they changed the market's internals with the circuit breakers and that sort of thing. And then we rallied pretty strongly in November for the record books into the Santa Claus rally right at the end of the year there. So seasonality is back on track. We put our forecast together right at the end of December, like we always do, the Friday before the Christmas holiday. We think we're pretty much in our best case and base case area. We're already up, 12% down in S&P. NASDAQ's up a little higher. This was dated from last Friday, so we got another percent or so on these. But vaccines are rolling out pretty well. Additional stimulus is coming, and this is from our December 17th, 2020 newsletter. We're seeing a pickup in travel and hospitality, unemployment going down. So we're leaning, base and best case on our outlook moving forward. Just a quick look back at the January numbers. Instead of just using the January barometer, we use a trifecta. Santa Claus rally, first 5 days, that's what SCR and FFDR, plus January. When all three are positive, it's fantastic. Up 28 the last 31 years for an average 17.5% over the year, full year for S&P. But the combo, which we had this year of up Santa Claus and up first 5 days with a January loss. We've seen the S&P down a bit in February, but the remaining 11 months up 81 or 82% of the time with an average 8.2% gain, a full year positive, almost 3/4 of the time with an average gain of 4.1%. I think we're gonna stay in that area pretty solidly. And that January loss was probably due to the J&J initial vaccine disappointment, which has now been rolled out. Also, down January is always a concern. Every single down January since 1950, followed by a newer continuing bear market, a 10% correction or a flat year. You can see that on page 20 of the Stock Traders Almanac 21. And just a reminder, we kind of did have a 10% correction in the NDX, the QQQs, the top tech stocks that are pretty much around the world. So we could chalk that up if you like. We may yet touch those levels again, but and then there's this December closing low indicator. Very, firm line in the sand that if the Dow closes below its December closing low in the first quarter, that's a negative. Didn't happen, positive. So we don't see any signs that the recent weakness is going to be manifesting anything deeper or major correction at this point. Looking for some soft sideways action, bouncing around between maybe the March lows and the April highs, somewhere in that range. And you'll see some of those technical levels on this chart coming up here. Just see how we're doing on time. We got a little bit left here. So this is, some people don't like all these notes and drawings on their charts. This is the way I look at it. This is the NDX, the NASDAQ 100, represented by the QQQ ETF. This blue line is the 200-day moving average, the 50 days, the pink line. We got a little 1, 2, 3 swing bottom here. That creates a nice support level here, which we danced around this 1300 to 13200 level. We broke through this uptrend from those, 2 March lows. There's longer uptrend since the September, October lows I highlighted for you on the previous chart. And right around the top of that previous 1, 2, 3 swing bottom in October, this is where the next level of support is. We held 1300 right on this trend line. So it's looking, like we're going to be range bound here. Some resistance, some support. And then what I think might be forming here is a potential head and shoulders top. Doesn't mean it's a bear market, but it does mean we can come down and sort of test those other levels that previously from back the other March lows. So here's what I'm seeing as a potential left shoulder, the head. It looks like we formed a nice neckline here, and maybe we'll get another little rollover right at the end of NASDAQ's best 8 months in June. And I suspect we'll be bouncing around between, the March lows and the April highs. That's the technical outlook for that. Looking ahead to next month, the June Almanac, third worst month for the S&P in a post-election year. You can see these daily probability numbers here. You see the beginning of July is also very strong, end of July week. Looking for that weakness in June right after triple witching, mid-month strength. So just to give you a little, look at the map of the calendar for June. One of the worst months of the post-election year for Dow and S&P. Not as bad as it's the end of the best 8 months for NASDAQ and the Russell. So June, July might be an opportunity to get further defensive, do a little more repositioning. So there's also this sort of Christmas in July rally, the end of June through the first 12 days, last 3 days of June, first 9 days of July for NASDAQ. But volume usually dries up after that. And we think this post-pandemic escape, people traveling, pent-up demand, they're going to be buying a lot of products and travel, but they're not going to necessarily be tracking the market as well. And of course, the usual exodus during the summer months gives us makes us prone to correction. August, September, the worst 2 months back to back. August is the worst in post-election year. So we think it's a good time to get defensive and take a little more risk off. You can see July, strong. First, ranked number 1 for Dow, S&P, NASDAQ. Number 2 for the Russell and the 1,000 and 2,000. Again, not a whole lot of down years in this, post-election year July. So another opportunity to lighten up. Just to look at the 4-year cycle, post-election years, worst 4 months. A little more support for why we don't think it's going to be a big negative, but more sideways. You got some average gains for the Dow and S&P, NASDAQ, 1%, 2%, 3% versus midterm years, much worse. Pre-election years and election years, not bad. So it's kind of the best, worst 4 months of the 4-year cycle. So another, reason for support, the floor holding on top of the Fed and the fiscal stimulus and the pent-up demand and that sort of thing. So the summer doldrums, as we call them, this is another shot right out of the 2021 Almanac. And we tracked this for the NASDAQ as well. So one of the contributors is this seasonal behavior of human beings not trading as much during the weaker summer months. Yeah, they come back in and sell some things at the end of August. It tends to be that weak spot, but you can see this dip below the zero line where the average volume tends to reduce in July and August as many of us tend to focus on other things other than the stock market. This creates that negative seasonality. Another look at that. This is from the back of the Almanac. It's page 148, I believe. You can see these worst 4 consecutive months circled here. July, August, September, the worst month. July, sort of the bear market killer or the turnaround month, where we get some of that October phobia. So again, a time of the year to be a little defensive, putting some cash on the side for a fatter pitch in the fall and getting into the best 6 months, best 8 months, right around the turn, sometime after October 1st. So seasonals, again, this is updated through yesterday. Seasonals still on track, as I highlighted from August of last year, 2020. You can see the first part of the year, 6 months, normally bullish, rising. We're starting to flatten off here. A much greater gain here in 2021 than the average. We've all been enjoying that. But this sideways action is what we're looking for. Might be a little more volatile than the smoothed version from a bunch of combined years going back 70 years or so to 1949. So we're expecting this chop here, maybe a little rally up here in July, a little sell-off at the end of June, and then pretty flat through August, September, and then looking for another, very typical seasonal October buy. So our updated outlook for 21, still bullish. We think seasonals are still on track. We expect any of that seasonal weakness to occur during the worst 6 months, May to October. We've already seen some of that. We expect the market to finish the year up somewhere in the range of our base and best case scenarios around S&P 4,200 or 4,300 or even a little more. So let's look at just a little quick recap of the best and worst 6 months. We like to do these 1-year seasonal pattern comparisons over different time frames. And you've got people that go back to the beginning of the Dow in 1896, May 26, as I mentioned earlier. But we have solid data that goes back to 1901. You can see it's pretty much buy in May in the old days. You know, it was a farming society where it was driven by, you know, the growing season, the planting, the sowing, and then the harvest seasons where you see that peak. But now that we have the you know, military industrial complex and the service economy, and everyone on that sort of summer vacation, Labor Day to Memorial Day to Labor Day, or the end of the London season in May, that sort of sell May and go away, come back in St. Leger's Day, if you know that old British saw. So again, we're looking for this sideways action. Anyone that tries to refute it going back further, you're looking at a whole different market with a farming society. Here's the average numbers. We've had it put through its paces. It's really the only proven black box system out there. If you want to hear more about it, you can reach out to us. But average gain in the best 6 months for the Dow, 7.2%, 0.8% May to October. Most of the market's gains were made November through April. Compounding a hypothetical $10,000 investment gains $961,000 in the best months. You gain $2,700, and the worst months going back 70 years. Roll in our MACD timing indicator, thanks to Jerry Appel and Cy Harding for creating it and putting it together. Still both given props in the Almanac. Turns that 7.2 to 8.9, and that little gain goes to a little loss of -0.4, but it nearly triples. It triples the results. It's over 3 million in gains for that hypothetical 10,000, and the gain, little gain turns into a loss of just about $5,000. So reposition in May to July, not sell in May. Sell the losers, short, let your winners ride. One of the oldest investment philosophies out there. We do sell some things in May, but we don't go away. We utilize our MACD to aid in shifting from aggressive to defensive. In our tactical seasonal switching portfolios, we sold the diamonds and the spiders. We'll be looking to get out of the Qs and the IWMs once we get our NASDAQ best 8-month sell signal sometime after June 1st. Picked up some of the bonds for a little defense, since cash isn't all that attractive right now. Straight up cash, we'll look for, you know, a little bit of protection in the bonds. We're also going to be rotating into some of the top worst month sectors. We're looking towards utilities and staples and healthcare. We're going to steer away from some of the shorts. We don't think there's going to be much to gain on the short side of the market this summer. Some of those sectors that we'll look at, the sector seasonality calendar. We put most of our portfolio and the stock portfolio on hold. We sell a few things, we tighten up stop losses, and we'll be looking to get into some new defensive stocks. We're looking for stocks in these sectors: utilities, staples, healthcare, as well as dividend payers. And then in October, on or after October 1st, we'll get our best 6 or 8 months MACD buy signal. We email it out to subscribers when it triggers, and we put out a new basket of growth stocks. And that's the strategy there. Here's a little look at the best 6 months MACD sell signal. Pretty timely signal this year. We're pretty pleased with how it triggered above the 0 line, where the MACD line crosses through the pink signal line. And, you know, just really couldn't ask for a better sell signal. Market did go up a little bit after that, but not much has been gained, and we think we'll probably be soft. Good opportunity to reposition the portfolios and reevaluate things and trim losers, et cetera, so forth. Here's our sector seasonality calendar. This is kind of this is right out of the Almanac. I sewed these two together, but you can see in this, you know, worst 6 months, worst 4 months period, there's not a lot of bullish. The bullish ones are long, for L for long in the color, and short is the gray ones. You see the short ones are sort of collected, or, you know, right here in the worst 4 months, and some of the buys begin here. The arrow is the beginning of the seasonality, but just a good visual picture as to why we like to be defensive and look to some others. You got utilities, pretty much the sole long strong the blue one long sector through the worst months. And then to look at this in a tabular format, so you see what some of these tickers are here. We got going through the calendar. Some of these shorts we're not going to be, you know, getting into. The material short, we're not going to touch that little pent-up demand with lumber being through the roof. But here you can see the cluster of bullish sectors beginning here in October, except for oil starts in July. Starts in December, goes through July. And, over the past few months, we've been sort of lightening up on some of these things, and you'll see that portfolio in just a sec. Let me just try to get through some other things here. So here's our ETF portfolios. Here's the tactical switching strategy portfolio, updated beginning of the month. Sold the diamonds and the spiders. We're holding on to the Qs and the IWMs. Picked up some positions in these 2 bond ETFs. So a couple dividends there. Here's the sector rotation. We're already in staples. We're already in healthcare. We're already in biotech. We're already in utilities, which we got into. We usually, make these pitches, these recommendations ahead of the seasonal period, so with a buy limit below the market. And unlike a lot of places, we actually give you not just what to buy, but when to buy and at what price and when to sell it. We also have some target prices for some of these sector trades. That's what we call the auto sell. We sell half on a double, and the stops are only on a closing basis, so it's not a stop you put in there. Looking at some of the stocks, we've got a lot of things on hold. We had a double here for Customers Bank Corp. Sell half on a double. Some pretty good numbers here in the small cap portfolio. This has been cleaned up a little. As you can see, we got one that we're buying because this is a utility. There's a little opportunity for people right there. Buy limit of 1545 for Algonquin Power. We made a nice trade on JetBlue. We had United, but that got stopped out on us. And then here's a look at the large cap portfolio. These ones in gray, as was Algonquin back here, were last year's defensive basket. Hung on to those because they're still doing pretty well. And we've got AT&T and Verizon and a couple of recent ones from the growth basket back in November. So portfolios gained about 585 since July 1 versus about 235 for the S&P. Combination of seasonals, fundamental stock screen, technicals, and just looking for stuff that's off the radar, not followed too heavily by Wall Street. So again, recap, still bullish for 21. Seasonals on track, looking for weakness in the worst months, May to October. We expect the year to finish up around our base and best case, about S&P 42 to 4,300, and we'll be neutral sort of until we get NASDAQ's best 8-month sell signal, which will come sometime on or after June 1st. And if you come join us, you always get a free almanac. You get all the strategies and buy and sell, specific buy limits and stops. Our market at a glance, which we really show you today, our best and worst 6 months buy signals. The only free lunch on Wall Street in December. And we have different portfolios, switching strategy, sector rotation, and the stocks, small cap, mid cap, large cap. So if you want to join us, here's a little code for you. It's usually $19.95 a month, 1 year for $150, 2 years for $250. If you do the 2 years, I think you might get 3 almanacs depending upon how long. No, maybe just you get the 21, the 22. You might get the 23 if it comes out then. So anyway, give us a call. And do I have any time for questions?
Hey, Jeff, you sure do. All right, you ready?
Yeah.
Yeah, listen, John's asking if you could please share, and I don't see it on that slide there, share your link for your main website.
StockTradersAlmanac.com. It's on every slide.
Is it? Okay, there you go. Oh, right there at the bottom. I see it. Thank you so much. Now,
I'm sorry. Yeah.
No worries. Can you share your outlook on commodities, metals, Bitcoin?
What's the thing about a 10-foot pole or an 8-foot Hungarian? Bitcoin, blockchain's going to be something. Got a little bit of a Ponzi scheme vibe for me. If you can trade and you're nimble, have at it. I might buy one of the ETFs that has it just to put in the back there. Commodities have come a long way. Yeah, it's kind of a new commodity bull market, but I'm not looking for a lot more upside for commodities right now. Lumber's already starting to come down, which was the big thing that with the whole housing boom. So not a big fan of buy and hold Bitcoin, but if you want to trade it and you got some skills, have at it. And commodities, I'm looking for more seasonals. There's a move in corn that some of the guys on the listserv that I'm on were talking about, and it runs right into the sort of seasonal period for corn. So that might be something to look at if you're into a sort of commodity that's not so mainstream.
Okay, great, thank you. And is it your birthday today?
It is.
Your voice went down.
55.
Your voice went down an octave. It is. Happy birthday, Jeff. So,
thank you, Chantel.
Well, hey, listen, happy birthday from all of us here at Money Show and everyone in attendance. But Christopher called it out in the chat room. So
oh, good.
Yeah. So all right. What in your opinion is the best season to buy biotech sector?
Well, I mean, it's one of my favorite sectors for the future. That it was the biotech sector that saved us from this pandemic, or at least helped us get out of it. But as you can see, let me go back. I'll show you on the slide. I mean, it's summer is the time to get into it. Here we go. Biotech is August through March. I'd look for any weakness here because they've come a long way. I mean, we have biotech in the portfolio since last year and just hanging on to it. You can get bar gold or a lump of coal with any particular biotech stock. I prefer to get into the ETFs on those, but great sector to get in there. If you can find a low buy point in late summer, that's the time to do it.
Okay, and can you give us some specific thoughts on gold?
Specific price targets? No, we hold it in the portfolio. It was a seasonal trade from the summer that if it keeps going up, you hang on to it until it breaks down. I think it's something you can trade seasonally, something you can put in the back of your portfolio for a little security if that's the kind of portfolio you have. But I don't see any major upside or downside on gold right now. It just seems to be sitting in a range.
All right. And if you like your positions for the long term, would you recommend selling calls against them throughout the summer months rather than sell?
That's the old school strategy. Sure. That's covered calls again during the worst 6 months. That's what they were doing before, you could buy a basket or trade an ETF. So answer, yes.
Okay, and let's end on this. You had a slide, but I believe, did it cover your membership cost?
$150 a year, a bargain at any price, and $250 for 2 years. You should make this money on one trade, if not many times over. And you get the free Almanac, which is a $50 value. So, if you're a trader, investor, it's a great thing to have for you.
Okay, and Jeff, where can we come and see you in person?
We can come see me in Orlando with you. I'll be there with bells on. I'll be there for the full show. We'll be on the floor with a booth, and I've got a bunch of presentations, and I'll be mingling around. So I'm looking forward to it very much.
Great. Well, we're looking forward to seeing you, Jeff, and thank you so much for this presentation today.
Thanks, Chantel. Everyone, have a great weekend.
All right, and we'll see you soon. Okay, thank you, ladies and gentlemen, for attending this session. We appreciate it. I hope you're enjoying the event, and I'll see you at the next session.